Here is portfolio. We have, let me go to the start of this. Here we go. We have market assumptions. I've already put in some assumptions for you. 0.04 for your risk-free rate, and then expected market return of 0.10, which subtract them to gives you a 6% market risk premium. Is an example of a common stock, which I gave you in the assignment, an ETF, a preferred, which we did not go over, and a bond, which we went over briefly last chapter. So for each one of these, I have the ticker, the company, the type, how many shares I want, price of the share, the beta, the annual dividend per share, and for Coke, the dividend growth. We left off here last class, and of course you have to provide the source. I've provided the ones that I have here. Your annual dividend per share, we went over a little bit of this. So for Coke, it was 51 cents, and it's paid quarterly. So we multiplied the 51 cents times 4 to get the annual dividend per share. Dividend growth is actually the dividend. If you do the historical lookup, and we'll go into that more here with the DDM tool, you're going to look at the final year, say year 5 or year 4, and then you're going to divide it by year 1, and you're going to take it to the 1 over nth power. So if it's 4 years, it'll be 1 to 1/4, which would be 0.25, right? And then you subtract 1, and that gives you growth. But for the dividend growth we're going to use, and typically is what is used, is the long run. All right, this is what you choose for your G. This is the stable growth rate. When we calculated G, we came out with, this is for Coke, we calculated 5%. That's your early years. So they're saying the quick rate is going to be 5%, but over a long term, realistically, you're going to go with a little bit lower rate. So it's 4%. The intrinsic value, the DDM column, is designed to work only with type common. That's why we worked in class, we did the common stocks, because there's a dividend and a growth rate. And of course we want dividend giving common stocks. So the constant growth, the DDM, is a common stock dividend model. ETFs, bonds, and preferred stock generally require different valuation models. Okay? Now I value one dividend paying common stock using a 2-stage DDM. High growth for N years, then stable growth forever. So we fill in the yellow cells under stock valuation A. I entered the ticker, Coke, the current market price, the required return, stable growth rate, high growth rate, and then high growth rate N. Then we have the dividend history. And this goes from D4 to D0. So this would be from the oldest to the newest. And this would be, since it's Coca-Cola, this is their annual each year. So you're looking at this may be 2025. That means this would be 2024, 23, 22, and 21. So it estimates the dividend growth in two ways. The CAGR method, which is your D0 or D naught divided by D4 to the power of the 1 divided by n power. In this case, it would be 1/4 or 0.25, and then subtract 1. That's what this calculation here is. 2 will average year-over-year growth. Here, year-over-year growth. Average of each year's percent change. This is just estimated to help pick my G1 and my G2. And then project future dividends. Okay, over here. So we project dividends for year 1 through 5. For year 5, the model assumes dividends grow forever at a stable rate of G2. So we compute a terminal value at the end of year 5. Then we discount that terminal value back to today. Intrinsic value is the sum of the PV dividends, year 1 through 5, plus the PV terminal value here. That's just your intrinsic minus your market. And then, of course, your mispricing percent is just your intrinsic minus market divided by market. The second part, stock valuation B, is for you to fill in. Again, the calculations are there. You just have to pick a stock, make sure it's a common stock that pays dividends. The BAC went to historical data, selected dividends only, and that gives you the dividends for the year. Then you go over here and you select 5-year. That gave me the 5-year dividends, which they pay quarterly. So of course, in 2025 you have to take the 0.28 times 4 and so on. All right, so here I provide a ticker for PSA, the preferred dividend per share, the DP annual, the required return, and the current market price. Preferred stock has, like this, often has an extra letter or series designation in it, in the ticker. Like I told you, Bank of America, BAC is their common stock. BAC dash something else beside it, like BAC dash PL. That's preferred. JP Morgan Chase and Company is JPM dash PJ. Wells Fargo and Company is WFC dash PQ. That should be a good indication that's a preferred stock. So when you search like Yahoo Finance, for example, it'll say under the security name, under the ticker, should say common stock, preferred stock, Series A preferred, or depository shares. If it doesn't say it anywhere, it almost always is a common stock. So the dividend behavior, a common stock, the dividends may change, may be suspended, yield fluctuates. For a preferred stock, has a fixed dividend rate, listed as a percent of par value, and looks bond-like. So if the dividend is expressed as 6.25% Series A preferred, that's preferred. All right, so the best bet for you to do in this assignment is just to pick common stocks, because preferred stocks are more of a hybrid security, and it combines features of both the stocks and the bonds. So it paid dividends first before common shareholders. The priority is liquidation. So you have a priority in liquidation. So it's paid after the creditors but before the common shareholders. There's typically no voting rights with a preferred stock. It pays a fixed dividend, often higher than common stock. It has a par value. It's sensitive to interest rate changes. So if the price falls, it's because the rates went up, and vice versa. Often callable, which means a company can redeem shares. Its risk profile is less volatile than the common stock. It's more income focused, and it has limited growth potential, where a common stock has a higher potential return, more volatile, and is the highest risk in the capital structure. Of course, there's voting rights, typically 1 vote per share. Dividends are guaranteed and paid last in liquidation. Has a greater potential for price appreciation, though. Efficient markets, the EMH. So here I provide you with an example. Again, I went with Coke. Description is a quarterly earnings release for the event. The event date, when it happened. Here, the closing price the day before the event, and the closing price the day after the event. Then the annual expected return from the stock, from your CAPM. And then, of course, the website that was used. So what we're doing, we're testing whether a public information event appears to be reflected quickly in price. All right, so the 2-day return is the price after divided by the price before minus 1. The expected 2-day return is just approximately 1 plus your annual expected return to the power of 2 divided by 252 minus 1. Abnormal return is the actual minus the expected. So if abnormal return is large, that suggests the price move was bigger than what we would expect from normal market risk alone.